Tom, great to have you back. Thank you. We wanted to use our time with you today to focus on an issue that's in business headlines a lot right now, and that's the issue of inflation risk here in the U.S. Inflation's basically been a non-issue for a really long time, but there are growing concerns that it's poised for a comeback, and we wanted to get your take on that.
It is a timely topic, so let's get at it.
Let's bring up a visual to set the context here. This is a business headline from CNBC, who recently interviewed a professor from the Wharton School of Business. He said inflation could reach 20% in the next 3 years. We've also heard people like Larry Summers, who was President Obama's Treasury Secretary, talk about worries about inflation. How should the average person be thinking about this, and should they be paying attention to these alarm bells that are going off right now on this issue?
Well, I think obviously people should be paying attention, but they should start out from a good understanding of the context, right? We've had relatively tepid growth with a very low inflation for the last several decades. And frankly, no matter what we've done, whether it be stimulus or policy changes or what have you, we've been unable to get the economy to run, at a hotter level or to generate inflation that would even meet the Fed's target level of 2%. And so we start from a position of inflation hasn't been really an issue in this country since I graduated from high school, and I won't tell you how long ago that was. However, we're in a really, really unique situation, working our way out of a once in a 100-year pandemic and the worst macro contraction since the Depression of the 1930s. And there's therefore a big suppression phenomenon in the economy, and the base effect of bouncing back from having shut down the economy for an extended period was bound to create a spike in prices on a year-over-year basis. So the fact that that's happening shouldn't lead people to get wildly excited that somehow inflation is back on a sustained basis. The only question is, does it subside to more normalized levels, 4%, 3% zip code in the medium term? And that remains to be seen.
Let's bring up a chart and have you look at this. This is the Federal Reserve's balance sheet going back to 2007 through the present day. You can see there's been just a huge increase in the size of the Fed balance sheet due to all the monetary stimulus that's happened, especially over the last 12, 14 months as a response to COVID-19. And that's what's creating these fears that inflation might start to occur. Just for the non-economists in our audience, explain the connection between monetary stimulus and why that creates an increased risk of inflation.
No one alive on the earth has ever been in this macroeconomic and monetary policy situation before. So there are going to be a lot of opinions about what we ought to do with it. And the reality is that the amount of monetary stimulus that's been provided here is truly unprecedented, not by a little, but by a lot. We've never seen anything quite like it. Now, the rest of the context is, interest rates were already exceptionally low. We were at effectively the zero bound, and therefore the monetary stimulus tools that needed to be utilized when rates were already effectively zero were lots of other things. And the purchasing of securities, mortgage-backed securities, and other things is another portfolio of tools that the Federal Reserve had available, and frankly that they added tools to and used very aggressively, and which we talked about together last year. That effectively amounts to them using various instruments to push, monetary growth into the economy, to stimulate economic activity, to buttress the mortgage market, for example, and to drive rates down, stimulate demand, and to try and put a floor under economic activity when it was collapsing. What that shows you on this graph is that by doing all of these things, the Fed accumulated a large amount of assets on its balance sheet by creating money and purchasing all of these assets to create monetary stimulus, more than they've ever done before in the history of the Federal Reserve Board. And obviously, they won't continue to do that. There will come a day out there not so far down the road where they decrease the amount of this activity, and eventually it will start to taper down to lower levels.
But what are the mechanics of this relative to inflation? Is it that you have more money chasing sort of a finite basket of goods and services? What is it that creates the inflationary pressure?
Well, I would tell you that obviously there is a correlation here between monetary stimulus by the Fed and the creation of inflationary conditions in the economy, right? We suppressed supply in the economy by shutting down lots of economic activity and factories and production and so forth. Now all of a sudden we have a very significant bounce back in economic activity, and the supply response isn't fast enough. So the combination of a lot more money out there in the system through fiscal and monetary stimulus. The consumer sector has more cash on hand than it has in a long, long time. Everybody wants to buy stuff, go on vacation, spend more money, and therefore there's lots of demand and lots of cash chasing a supply side of goods that isn't going to be able to keep up with that, and that's going to drive prices up, and you can see that in a variety of areas of the economy already.
Let's go to the next chart, which illustrates that this isn't just theoretical. This is the consumer price index going back to 2010, and it's a measure of inflation that economists look at. You can see here there's been an increase, a spike up in the last month to over 4%. I think it's the highest level in a long time. Is this cause for concern? Is it the start of a trend, or is it too early for anyone to declare that this is something to worry about?
Whether it's inflation or anything else, one data point does not a trend make, right? This data point is partly a consequence of the base effect. Right? We were so low that you bounce back and it's going to be a big number. We fully expect to see inflation stay up at higher levels, not for a couple of months, but for a period of months, as the supply side of the economy responds to that big stimulus of demand, both from fiscal stimulus and monetary stimulus. So I'm not concerned, and I fully expect that inflation is going to go up to these kinds of levels. Our hope would be that it would level off and stabilize around there, and then over time, in the medium term, start to go back down closer to more normalized levels in the 3% and down towards 2%. In the medium term.
The final question, which is the one that investors and borrowers think about a lot, which is what is the Federal Reserve likely to do? They've got a meeting coming up in June. Is there any chance that they would start to signal a tightening path then, or do you think they're going to let things ride for a while before they do anything like that?
They are the responsible authorities. They have to take the necessary decisions. Therefore, we have to take very seriously what they say. I take them at their word that they are very data dependent and that their intention will be to wait for the data to show them that it is in fact above the levels that they expect before I would expect them to start taking any action. But given the slack, for example, in the labor market and other indicators, I don't believe that they will act more aggressively than they have publicly stated unless the data shows them that it's cause to do so. Remember, in the past, they might have taken anticipatory actions in expectation of inflation going higher. They've been very clear they are not doing that anymore. They're going to wait for the data to show that they're actually there before they act. We can expect, though, that before they take any action on interest rates, that they will precede that by taking actions to address the growth of their balance sheet and to stop using some of the tools or to slow down the rate at which they purchase financial assets and so forth so that they can slow that down and over an extended period of time exit those tools, put them back in the toolbox in an orderly manner that is not disruptive of either asset prices or the orderly function of the capital markets.